Okay, good afternoon. Welcome to a very special webinar that we have today, How to Screen Like an Investing Champion with Mark Minervini. I am going to give you guys a few minutes to roll in. We have a lot of people that are joining, and Zoom has like a queue where they allow people to move in.
That was a lot of people in a short period of time. Holy cow.
Yeah, let me change my profile name. All right. Okay. So it looks like we've got a number of people have already filtered in. So let's get started. So again, this is our webinar, How to Screen Like an Investing Champion, with our special guest, Mark Minervini. Mark, thank you for joining.
Thank
Very
you for having me.
quickly, I'm not licensed. I don't believe Mark carries a license. That this is not buy, sell, hold recommendation. Please take a moment to read the disclaimer. And like I said, Mark is our special guest. And my name is Scott St. Clair. I am the manager of the premium product group here at Investors Business Daily.
And yes, that picture of me is like 15 years ago.
Yeah, mine's getting old too. So you find a picture you like and you just run with it, right, Mark?
Yeah, I look so good there. I gotta,
I
gotta keep it. I'm an old man
Our,
now.
you and me both. So our agenda, we'll talk about the current market environment. Obviously, I know a lot of people will be curious about that. We will get very quickly how to build a custom screen using MarketSurge. Spend a few minutes on that just to kind of give you a quick overview. Then we'll go into Mark's routine. What does he like to screen for? And then last but not least, we'll highlight some of those screens, some of the most used screens in MarketSurge. And did they help you to identify, some of the previous winners in the current cycle as well as the past cycle? A couple of housekeeping items. I apologize. I don't know how to turn off the hand raise feature. So it's not that we're ignoring you, but the hand raise feature is not going to be used. I do have a handful of colleagues in the background. So the Q&A, if you have a question, you can type it in and we'll do our best to get to you. There are a lot of people on this webinar, so please give us a chance to respond. And if not, we will give you some contact information for after. And this webinar is being recorded. So if you're on here live, great. You can revisit it if you'd like. If there's something that you weren't sure about, or I'm curious about, like how did Mark talk about that? You can go back and watch it. It'll be under investors.com/webinars in the video section. And that'll get posted sometime later today. Give us a chance to drop that in. Okay, so let's get to the heart of the matter. Probably what a lot of people are curious about is this market and Mark's thoughts on the market, starting with this screenshot of the IBD 50 index.
Yeah. So Scott, this is a market that has been interesting, to say the least. But it's classic. It's no different than, we've gotten tons of questions in the last couple weeks and months that, is this any different than before? Have you ever seen anything like this? Yeah, over and over and over again. It's really nothing really any different. I think this is a garden variety correction that could get worse. We're very oversold now. You can easily get a snapback. We do have somewhat of a snapback rally, little snapback rally taking place. We'll see if you get a follow through day, if you get an official follow through day, but that's just one piece of the puzzle. But real quick, I just wanted to sort of go through a chronology for those who follow me on Twitter. I've posted many times along the way here what I've been doing when I went short the market and so forth. We have something called the STEM model. It's a stock trading environment model. It's basically what we do. It's not a mechanical model. It's subjective. So it's based on our read of how breakouts are working and how many setups are developing and whether they're failing or not. And it basically is red, yellow, or green. Yellow is tradable, but with caution. Green is what I call an easy dollar, all out, trade very aggressively, and red is be very, very cautious, very selective. You don't have to not trade at all, but you definitely want to have the smaller positions, more diversified, less exposure, and tighter stops, and very quick to move the cash if things move against you. That's what we're in now. So this is when it changed to that, the most recent change. And there was that break that happened. You see in the IBD 50 just prior to it. No, just prior actually. Yeah, and that we were starting to see some setups there, and then the IBD 50 sort of broke apart, and we saw a lot of stocks breaking apart. And then we had that little rally back. It wasn't really helping the stocks repair. It was just showing broken names that were just having little snapback rallies. So we went on to that red, and then we rolled over from there. But the thing that I want to point out is a couple things. One, the IBD 50 was showing the type of names that those are on this call. Most likely 90% are following more CanSlim type rules, and the type of rules that I use that are homogenous with CanSlim. There was a lot of signs already there, and just looking at the IBD 50 alone, it wasn't acting right. A lot of stocks were breaking down. Since then, off the highs, we're down 30% or 29 point some odd percent off the highs. That's a bear market, and 30% is a pretty big hit on an index like this. So you probably, if you're in those type of stocks, you've been feeling some pain.
All right, and let's talk about the S&P using this chart of the ETF SPY.
Okay, so again, going back to my tweets where I posted that I shorted the SPY on the 24th of February. That was shorted after the STEM model rolled over. We have another model called the risk model, and it's more, the STEM model is 25% of it, but the rest of it is all market related. So this is more of a market index type model, but it's on a shorter to intermediate term basis. That started turning very negative. And when we see the stocks rolling over, and it's really an O'Neill type method. The O'Neill method is you follow through day, stock setups, you go in the market. you know, um, no stock setup, stocks are breaking down, distribution, you're out of the market. That's it, and it sounds easy, but it takes years to get the expertise to read that correctly, and there's a lot of management in between. Things don't always go perfectly. This time it went pretty perfectly. We got the stock started acting poorly, then we got the distribution in the indexes, and we got the risk started to rise. The volatility rose, so I went short and with a very tight stop. It was just 3 days off the high. The stop was at the high, and it never came near the stop. It just went right down. So now the next thing is our longer term. We have a longer term model, which I'll show you. Yes. So
This one, okay.
yeah, this is purely mechanical, and this is something that the components of this that make this up. This is very complex, and I've been following these components, and Ned Davis Research has been calculating these for me and going all the way back to the 1990s. I was actually following the components of it in the 80s, and then I became a customer of Ned Davis Research in the 90s, and then they started calculating those various individual components, and then we put it into a model, which is an allocation model that I used to supply to institutions, and now our customers get this. Very long term in nature. You only get signals on once a year, once every couple of years. If you go back to the 1990 buy signal, that was stayed in a buy signal all the way till 2000. So it was a 10-year buy signal. The thing that I want to bring out today is that there's some reasons to be bullish short term, but I would respect a sell signal on models like this that are longer term in nature with the long term trend, because there's also some longer term warning signs that I want to talk about today, that there is the potential also for maybe a bigger bear market than we think, or something more severe. So we don't want to get caught with that, because then when we're coming back into the market, if we're licking our wounds and coming out of losses, all we're doing is getting back to break even with all the gains that we make, and we want to compound money, not mistakes, right? So this model has just raised cash. I think you have another chart of that. Um, this started raising some cash. It was on a 100% buy signal since January, I believe it was January 13th of 2023. That goes back quite a bit. It was on a buy signal, and it's still on a buy signal, but it ladders down. Once it goes to 100% invested, as it starts to deteriorate, it raises cash with the market. So it just raised some cash, and so and a couple of the components are right at the point where if the market goes down a little bit more, it's going to raise more cash, and it's going to be almost 100% in cash, by about 25 to 33% in the market and mostly cash. And it will go to 100% cash too at some point. So that is kind of on the verge here. So we're sort of in a critical point at this point. Now, on the shorter term basis, we recently just covered half of our short position. So that kind of goes against the longer term model, but that was a shorter intermediate term trade, and the market was heavily oversold, and we saw sentiment getting very bearish. So I covered half of it, but we'll see what happens if this market starts acting not right, I might actually add that back. But here's what I did, and this is what I do very often. Sometimes I'll short the index when the market's rolling over. Then I cover some when it gets oversold, and then on the rally back, if we see what we need to see on the upside, I start adding longs and I dilute the short. The short then becomes a hedge, and then one of the two will win. So if and I the way I'd like it to pan out is I add longs, I dilute the short, and then the short actually either stops me out at break even or I take a small loss and I'm loaded up with longs and the market is bottomed. If it doesn't, it goes the other way. I get stopped out of my longs because I'm usually only coming in with a smaller position. I'm not going right in there 100% invested. If it doesn't work out, I'm hedged somewhat. And now the market rolls over. I get stopped out of my longs. I still got some of the hedge on. That's where I'm at right now. And I'll tell you the exact stocks in a minute if you want to share those that I've recently
Yes.
bought and exactly where I bought them. We've just added some names. Let me see. I don't remember what the next chart is, so you have to bring it up and then it'll. Okay, so this is the sentiment. So see, sentiment has gotten very, very bearish, if you will, which is bullish from a contrarian standpoint. You can see we're down to bear market levels, but you can also see when we first rolled over into the bear market in 2022 that we were at these levels and then we went much lower and we had to get even more bearish sentiment. So it doesn't mean just because you have the bearish sentiment that you necessarily are going to bottom, but we do have enough bearish sentiment to certainly foster a rally, to foster some kind of snapback. Right now, it's a matter of if we're going to actually put in a real bottom here, and that's where we just turn to the stocks. Once the market gets oversold, the sentiment's real negative. If we get a follow through day, we start seeing the indexes firming up. If the stocks are breaking out of basis, we start adding names, and then it's just whether they hold the stops or not. If they hold the stops, then we add. If they don't, then we get knocked out of the market and we go back to cash. So that's where we are right now. Let's see, what else do we have? Yep. So this is the problem. So even if the market were to bottom, and here's the problem about when a market's bottoming, it's very volatile. It's whipping all over the place, and that's why you have to be very careful to not think about picking a low. Because if you're trying to pick a low, well, you're going right in the most volatile time. And while the indexes may bottom, you still may get chopped up with stocks whipping back and forth that have not found their footing yet, and stocks aren't moving in earnest yet. People think that O'Neill would just plow in there when there's a follow through day. No, the follow through day is one of the elements. And then when you have the stock setups, you start adding them one by one. And if they're not working, O'Neill would never be adding exposure if his first few games weren't working. It's not there's no intelligent reason for you to go to 50 or 100% invested if at 25% invested you're losing money. You really got to be patient here and not get so locked into looking at the market indexes. Right now, if you're going to look at anything, look at volatility. When that volatility comes down, that's where, and you see, look, we're running at bear market levels of volatility. If you look to the left, where we had that nice rally from, yeah, not that far, but say from the rally in April, July 23, all the way till, maybe July of a year later, see how basically, yeah, that whole rally, we had that lockout rally, we had very few pullbacks along the way at a 10% correction, but it was really a nice, easy dollar environment. Look how the volatility is low through most of that period. Then when you get that high volatility, that's where you got to be careful because even if the indexes do well, the average stock is whipping around, and if you're using tight stops, you're going to get knocked around, and you're going to get losses because you're keeping the risk so tight. So right now is a time where you got to be careful because of the volatility. Um, so that this is the IBD Mutual Fund Index. This was like a canary in the coal mine. I pointed this out to my clients. I think it's 14 weeks ago now. That this big weekly close below the 200 to me was a major, major sign, and I was really taken this very seriously. And then when it couldn't rally and it just went sideways, these are some of the best mutual funds. There's really great mutual funds in the IBD mutual fund index. I think you still have Alger and those guys, and
Yep.
yeah,
Fidelity Contra, Will
Da-
Danoff.
yeah, David Alger was one of my heroes. I know I learned a lot from David Alger, and unfortunately, he perished in 9/11 in the World Trade. But his brother Fred, of course, I think still runs Alger funds, I believe. I'm not sure. I haven't been in touch with that in so long, but they were real heroes of mine. They're great managers. There's a whole bunch of funds in there, and they're not doing well. They're not doing well, and the IBD then breaks down. So this is really telling you the type of names that we would traffic in are under pressure. And the real masking of it is because Nvidia Nvidia and Google, and those are starting to give away now. They're below the 200-day. They were still holding up, and they were holding the indexes up because and I've been talking about this forever, even on these shows. The indexes are weighted, 30, 40, 45% of the index is in 10, 15, 20 names. The S&P, I don't know, 25 names, I think, is like 30, 40% of the index. Don't quote me exactly, but a huge percentage of the index is just a handful of NASDAQ names. So again, you have to look beneath the surface. When you have that kind of market where everything's so weighted like that, the indexes aren't telling you the truth, and you need to go to other indexes that are either maybe equally weighted. And this is really the areas that are really good to look for the type of stocks we would traffic in. This just goes, and this is something O'Neill said, and I learned many, many, many decades ago. The worst thing that a stock can do is break and not rally. The best thing a stock can do is break out and not pull back much. So that's why strength begets strength and weakness begets weakness. This broke hard and had a big week. That was the biggest week down since the bear market, and it could not rally. It was just screaming that and this is what I call a ledge. A friend of mine, Lauren Fleckenstein, who used to write for IBD and then he went to trading markets, he wrote an article on this. It's probably can dig it up somewhere online where this about this ledge pattern, and it's what I look for to short. Is when you break below the 200, you just go straight sideways, you can't rally, and then you start breaking down from there. So this, of course, broke down even more. It's down about I think it went down about 23, 25%. So again, bear market levels here. So there were signs here before we had this decline, and I think it's still a little bit somewhat ominous right now. Let's see, what else do we have? Okay, so this is what flies in the face. I know we're going kind of long here on the general market, but there's some pretty interesting things to look at here. This flies in the face of what the investors intelligence and the AAII surveys are saying. This is another survey of expectations for stock prices. And this is one that is telling us that there's a lot of expectation for stocks going forward to have increase in stock prices. And if you move to the next slide, that's the one that's really important. And again, this is as of 12/31. So this is quarterly data, so it's not updated recently, but as of the end of the year, we had a record level of stocks being held in households. And this has been going up over years. You see the trend from the 1950s is definitely higher highs. Well, let's even assume that this can go even higher. Well, okay, 100% would be fully invested every household in America. We're up there at 50%. So we're definitely there's a lot of supply out there. So there is the potential for large declines. And I'm not saying get bearish, don't buy stocks. If they set up, you buy them because the party, they may not pull the punch bowl away for a long time. But when they do, and you see those signs, you need to run for cover. You need to not say, oh, it'll come back, it's Nvidia, and start buying these stocks because they're down, because you may end up in another situation like we ended up in 2000, where you go 20 years before the leaders come back. Microsoft took 20 years. GE, I don't even think GE is back to the old highs yet.
It
You know,
isn't. You're right.
yeah, you can go for a long, long time, and maybe they won't go out of business, but maybe you're in your 60s like me, and you'll need the money, and you won't have it then when you need it most because you're in a big bear market, and it's taken 5 years or 10 years or 2 decades to come back. So this is sort of the landscape. This is the way I'm playing it. I don't know if we have any other slides, but I
I
certainly
think there
can.
might be one more. Yeah.
Yeah, that's just another look at, stocks as a percentage of stocks, bonds, and cash. Again, a lot of ownership, a lot of stock ownership. And this has been rising, and maybe it goes even higher. But I don't think, I mean, I think if you got into the 60%, 65%, you would be at absolute nosebleed levels and would be probably a prerequisite to not a very nice market going forward. So I think it's something to be mindful of. But if you want to go over some individual stocks too, I don't know if you want to
Yeah,
wait for
let me
later, we can do that.
pull up. Let me see. Can you see my market search chart?
I can, yes.
Okay. So let's start with some stocks that you mentioned. Do you want daily or weekly charts?
Daily's fine. Yep.
Okay.
We
So
just entered
here's
this 3 days ago.
MWA
Yep, just entered this 3 days ago.
right
Had a
there. Oh,
big up move on earnings, then it pulled back during this correction, and then had another real nice up day, two really big volume days on both of those up days, and then tightened up real nicely. We bought this 3 days ago as it was breaking out because this is one of the first stocks to emerge off the lows here. It's a potential leader going forward. So this is one that we're in. I think we're, most of the names we're in right now, we're up between 5 and 10%. So we don't have any really big gains yet. We just started putting sort of the toe in the water.
so this is Alignment Healthcare. I think you said 314, and
We added that,
so right
yeah,
in there
right
somewhere,
there.
right?
Yeah, we added that about 4 days ago, and then we added to it. I think I gave you that. Let me see.
You said 314 and 318, right?
Yes, 314 and 318. Those are the 2 days I bought that. So that's another one that held up really well. And you can see that big move on the earnings. It was up nice and big, came back, a nice orderly pullback while the market was pulling back. And this is what we'll talk about later with screening. Look at that relative strength line. See it just soar into new high ground because the stock is holding up while the market is correcting. And that's precisely what we want to see. And if you go back, you can go all the way back to 1990 when Bill O'Neill and David Ryan and myself, we were all buying Amgen, we're all buying U.S. Surgical, we're all buying Ballard Medical Products, even Home Depot, when they were a mid cap company and nobody even hardly heard of them. This is what they looked like. They all looked like this. The market was in correction and they had relative strength lines going into new highs. Most of them 98, 99 RS numbers and RS lines going to new highs, breaking out right off the lows.
All right, let's look at, oops, a typo. Baba is another one you mentioned to me.
So Bob is sort of a turnaround or refocus. And if you see the ants in there. So this showed some pretty powerful action. When you see the ants, you can see those on the Market Smith charts. That shows 12 out of 15 days up. That's something that David Ryan developed. It just shows that there's some real power there. And the fundamentals behind Baba are they're making investments in AI right now. This is really an AI excitement over the stock, over the AI investment and bet that they're making, and a company that is probably, relatively speaking to the other companies out there, they're undervalued to the street, I would say. I don't buy value, but this is showing tremendous power, 98 relative strength, coming out of what we would call a power play or a high tight flaggish. Very strong. We just actually bought a little bit of it today on the pullback as it started turning up. And if this breakout is for real, it should really hold up and with maybe another day or two of pullback, and it should be back a new high ground. And if this comes in, I'll just be out of it. I'm looking for this to work right away. If it doesn't work, I'll be out of it and be looking for maybe a reentry.
Okay. All right. So I think we had one more chart. Did you want to talk about margin debt at all, or do you feel like
Margin. Okay,
you've
well, real
made
quick,
you've made
margin. Yeah, I made my point. I think on the longer term
yeah.
excess, froth. Margin debt is also getting up there. But one thing I wanted to point out that's not in margin debt anymore are these leveraged ETFs, and I think margin debt might be understated. This is something that I talked about and was brought up by someone on Twitter that pointed it out, and I thought that they were absolutely dead on. That margin debt, yes, we're seeing margin debt at levels that have in the past been frothy. But on top of that, you have all these triple ETFs and products that don't even show up in this. So I think it might be understated. So we got to, again, it's another sign that we're definitely not in the early innings, maybe on a longer term basis.
Yeah, it's different world than when we first started. If I wanted to be short, I had to sell short. Now I can buy the triple short Tesla
Yeah,
ETF or something,
yeah.
right? Yeah.
I still
S-
short the indexes because I like to be short when I'm short. People ask that all the time. Do you use the inverse? I short the SPY. I short the DIA. I short the Qs because I like to be short. I also don't like when you get into the leverage, the triples, especially over time, they don't track. So if you're just trading them very short term for a day or two, fine. But if you're going to hold them weeks or months, they lose their tracking. And we saw there was a while back we saw a decoupling of some of these and everything went kind of haywire. So there is some additional risk there.
Yeah, I agree. All right, so let's talk about screening and market surge, and we're going to let me fit my chart to screen here. Apologize. I don't know why it's not fitting to screen. It should not be. Shouldn't be able to see the this down below. So
Um,
it's a user error for sure. Let me relaunch
what
my
down below?
charts.
Did you just, yeah, okay.
I'm
I was
gonna
gonna say, did you just pull the tab up? Sometimes you just pull that tab up.
I'm gonna
Are you trying to get into the bottom screening?
I want my chart to fit the screen, and
Oh, I
people are
got you.
saying that it's not fit to screen. So um
When in doubt, reboot.
yeah, exactly.
We were trying to,
Um
my team and I were developing our new software right now, and we had this problem, this hiccup, and we're a week. It was driving five of my coders crazy. Guess what? Today we've realized it was on my computer. It's because I had my batteries were low on my mouse. We're checking all the code. I mean, I don't even know how much money I spent paying everybody to check everything. And it was my mouse
oh
was low,
jeez.
was getting low on batteries, and it caused this
All
weird
right.
hiccup.
I apologize. Hopefully you guys can see my screen pretty good. So let's open up the screener on the left-hand side of the chart. And if you want to build your own custom screen, some people want to. We have a lot of built-in screens, which we'll talk about with Mark in a moment here. But to build your own custom screen, you would just click New Screen and New Stock Screen, and then you could just call it what you wanted: IPOs, EPS screen, etc. And then all the criteria you can screen for are in these categories right here. So if you wanted to screen for earnings, let's say quarterly earnings up 50% or more. Well, here's the quarterly earnings block. I want a minimum of 50%. I don't have to put in a max, the more the merrier. And boom, I can get 576 stocks have earnings last quarter up 50% or more. If I want to make sure that XYZ lost a penny, but now they've made 5 cents in the most recent quarter. Well, if I want to make sure I see that kind of absolute value, then you would just check this box, include stocks with negative comparison quarters, and you can see how quickly the number jumped by doing so. So there's a lot of items you can do to screen from a custom standpoint, and then there's a lot of built-in screens that we've pre-built to try to make your life easier, and that's probably where we're going to go now. So before we go there, obviously the MarketSurge is sponsoring this webinar, so to speak. We do have a special offer. We're in the middle of free access week, so a lot of you have free access to MarketSurge until Sunday, I believe. If you want to continue, we are offering you 1 month at $24.95. It's normally $150 a month, $149.95. So $24.95 for a month. If you sign up today, because you are in the free access week, we want to make sure you don't lose that free access time. We're going to give you a bonus 2 weeks. So if you sign up today, if your order is entered today, 319, you will automatically get 6 weeks for $24.95. You can call us 800-831-2525, or you can go to investors.com/webinar offer to explore that offer. All right. So Mark, let's talk about your routine. How did you find the BABAs, the MWAs, the ALHCs of the world?
Yeah.
I'm going to pull up my MarketSurge and just you guide me on things that you like to look for. What are some things that you would do to generate ideas?
So let me first say I have been using Market Surge in one shape or another through all the name changes and all the technology changes. I started with daily graphs that were a printed product, and they would be mailed to you on the weekend. And then you would have to imagine throughout the week where the price was. And we used to just mark it in with a pen on the charts that we liked because they only came once a week and they would get FedExed on the weekend. And then you got daily graphs online. Then you got MarketSmith, then it became MarketSurge, and now it's evolved and evolved. And I've been through the whole thing, so I've seen the whole thing. But the real interesting thing is that through all this, I'm still screening the same way as when I flipped the printed pages and just looked at them and bent the corner tab on the ones I liked. It
Mhm.
really hasn't changed. It just allows for faster, more precise and concise and efficient screening, and to make life easier and just quicker, really. It's definitely more comprehensive. And so I like to keep the screens pretty simple. This is the first rule you have to know about screening because everybody wants the magic screen. And there's a couple things. One, there isn't a magic screen. You still have to do work. Two, the thing you have to be careful about is putting too much criteria in your screen because if you put 100 items in it and it meets 99 of them, all right, and it doesn't
Yeah.
meet just one, you don't see the name. So, and now 99 out of 100, that'd be probably a pretty good stock, but you're not going to see it because it doesn't meet one criteria. So you've got to be careful when you make the screens for two things. One, for a lot of criteria, and two, fundamentals versus technicals. Because again, if you have great fundamentals but the technicals are poor, well, then you're going to be looking at stocks that you get enamored with because they have big earnings, but they're not showing. Another O'Neill basic rule is, the management's great, the products are great, the earnings are so great. Why is the stock got a 22 relative strength and hitting a 52-week low? That doesn't make sense, right? I call it differential disclosure. So I separate the two. I have some hybrid screens, but I keep them very simple. And the EPS rank is what makes it the easiest for fundamental screening. If you really want to find the best stocks, just put in the EPS rank of 80 or better, and then screen on technicals, and you're gonna see pretty much everything that you want to see. You're gonna see all the best earnings. Is it going to catch everything? Maybe not. Maybe there's a couple slip through the cracks, but you're going to catch pretty much everything. Then you want to see, that's going to rule out some of the biotechs and some of the companies that they don't trade on earnings. They might, they're new drugs in the pipeline and they don't have any earnings yet. They might not even have any sales. That's for you on a pure technical screen. So I sort of separate those. That's the sort of the first thing about screening that you have to understand. Not too many variables, and separate the technicals from the fundamentals. And if you're going to put them together, then once again, have just some qualifiers. So maybe you have an EPS rank, but then you run all the technicals. So we can
Yeah. So
build,
it's
yeah.
funny, like when Nvidia was going like this, the EPS rating was super, super high and the relative
Yeah.
strength was super, super high. But
Yes.
now it's the fundamentals are still strong, but the relative strength is kind of rolled over. So and no surprise, the stock's kind of not going anywhere at this point.
A
So
general rule of thumb, Scott, that both David Ryan and myself have is that we buy stocks on technicals and fundamentals, and we sell stocks on technicals, usually only. Now, if fundamentals really deteriorate and you get a lot of deceleration and the stock goes parabolic, we might sell into a climax run, and we're selling good technicals and the fundamentals would deteriorate. But
mhm.
most of the time, the fundamentals will lag the price. The price will discount. It's just the way it works. We've studied the stocks going all the way back to the late 1800s, and it hasn't changed, and I don't think it's going to change. So that's why the technicals are really important. Don't get too enamored, like you said, with the fundamentals when the stock's showing you a sagging RS line or
So
RS number.
here's Nvidia as it was starting to go, right? The earnings on the table that were being reported were very pedestrian at best. They were
Yeah.
negative, but what you said is so important. The stock was anticipating these numbers. Look at that: 440, 367, 478, et cetera. 567. My eyes are bad. So the market is anticipating these huge, huge earnings. And then who knows? I don't know where Nvidia is going, obviously, but if it were to continue like this, guess what? The earnings that would come in, they'll
Yeah.
probably be good, but they won't be like this. They'll be like
You almost
35% or
certainly will see a slowdown
55%. Yeah.
2, 3, 4 quarters down the road. And then you'll say, "Oh, now I see why the smart money was selling the
Yeah.
stock." But here's
So
another thing
let's,
to understand,
oh,
Scott.
go ahead.
You with growth stocks, because they have such a long cycle, and this is going back to the O'Neill studies and our studies, you don't have to predict because the cycle's long, so you want the earnings on the table. I often point this out, and I asked David Ryan one time in one of our master trader programs, did you ever see O'Neill? And I asked Mike Webster the same question. Did you ever see O'Neill buy a stock with poor earnings? Both of them said no, never. Can't remember. Mike said, I think I remember one time in 30 years. Never, because you don't have to. The earnings are on the table already for the growth stocks, and if you are in the beginning of a new cycle, there's a lot of time. So don't think you have to predict.
Great. All right. So let's talk about the Minervini trend template, which you worked with former colleague of mine, Arusha. You guys worked
Yep.
closely to build this. And there's two places you can find it in MarketSurge, down in this bottom left corner. It's in the folder called Technical, but you also have this Open Stock Ideas button. And we've got a favorites button, which is really nice. And so I can add the one that I like the best is the 1 to 4 month trend. So that's been added to my favorites. So you could do that. That way you don't have to go down here and look for it. But we have a handful of what we've got: the 1 month, the 1 to 4 month, the 5 month, and the 5 month wide. So let's talk a little bit about what these are doing. How are they generating ideas?
So I'm actually having dinner with my very good friend Stan Weinstein, who most of you probably know. He's a living legend for trend analysis. Wrote the book on it. Having dinner with him on Sunday. Matter of fact, down in Fort Lauderdale. This is where it all started for me. I met Stan back in 1990 at October, right around the lows of the market, of the bear market, in New York. We had lunch together, and he convinced me that I should always qualify a stock with an uptrend first, and that's where this came from. And so we coded this where this is a qualifier. This is basically where this is the starting point. If the stock doesn't meet this screen, I'm not even interested in it. Now, the 1 month isn't what we call an early turn. This is when it starts to get into an uptrend, but hasn't gotten into what we would call a confirmed stage two uptrend. But you get high tight flags and power plays. Sometimes they take off and they go so fast off the lows, they don't give the stock enough time or for that moving average, a 200-day to turn up and to really get into that uptrend. So to find those, you would run the 1 month. But the most of your stocks, the growth names, the ones that you're going to look for, and I think we have a chart in NVIDIA and show exactly how this transpired in real life. Um, most will be in the 1 to 4 or the 5 month, where I want to see 4 to 5 months of uptrend before I even consider a stock. 90% of the time, on 90% of my trades, they're going to already be in an uptrend. So this is a qualifier. You can set your screen to use this as the database. You take the database and you break it down to where they have to meet this qualifier. And then you don't have to go through thousands of names and try to figure out whether the thing's in an uptrend or not.
So what Mark is talking about, so the 1 to 4 month has 157 stocks. You can see here items. There's two ways you could narrow this. You could just sort this list. So if I clicked on the composite rating, that would bring all the 99s to the top. Or you could screen this list. So if you're let me go to new screen, and I'll just call it the 1 to 4 mark. So instead of screening the MarketSurge database, which is 10,700 stocks and ETFs, about 5,000-ish stocks, I could change that, and I could change it to the 1 to 4 month or the 5 month. So if I choose the 1 to 4 month, for example, now instead of searching for 10,000 inside the universe of 10,000 stocks, I am now searching inside the universe of these 157. Next week, it might be, pardon me, it might be 200 stocks. It might be 130. It's dynamic. It's constantly changing. But I could say, okay, I prefer an EPS rating of at least 85. And so there are 23 stocks, you see right here, with an EPS rating of at least 85 that meet, that are inside this trend template of 1 to 4 months.
Right. And if you did the 5 month, you would see more because it's 5 months or more. There's always going to be more names on the longer time frames as you go to the longer time frame. That's where most of mine are going to come from. So you can see there's 112 that meet the 85 EPS. But this is a pre-screen. This is what I call non-negotiable criteria. It's my starting point. If I can't meet this screen, then I'm not interested in the name because it's not in an uptrend yet. And here's why. Might have heard me say this before, but I'm going to repeat it for those of you who haven't heard it. when you go back and you look at the biggest winning stocks of all time, going all the way back to the 1800s, 98% of them made the biggest part of their move. The big run that was the biggest move of all time was made while they were in a stage two uptrend, while they met this criteria. So the simple question I ask everybody, would you rather have the 98% club or the 2% club? You want a 98% probability of having a big winner or a 2%? Because if you're going against that, you're going against 130, 150 years of history that say that a big winner is in a stage two uptrend. So why would you want to be in a stock in any other time other than when it has the potential to be a big winner?
Okay, so let's talk about two others that we're going to highlight, and then we're going to show you some examples from previous cycles. So we also have relative strength. You talked, Mark talked a lot about relative strength. So we have a screen in my favorites. I've got one called the All RS Line New High. So what this is doing, it's giving me all the stocks today, for example, and it'll be historic where the relative strength line made a new high today. So like I happen to have AEM highlighted, but here's the list of stocks down below in this list panel, Howard, which has been a really good one, et cetera, et cetera. And you could do the same thing. You could either sort this list if it's you by composite rating to bring the kind of the cream to the top, or you could screen this list as well.
And you can also, there's another variable in there that you can screen for close to the high, the
Within
RS line
5%.
within
Yep.
5%. So if you want to sort of get a heads up on it, that will have a lot more names. That's going to be more plentiful in the names. But when you're in a correction, you want to see the relative strength lines hitting new highs because the stock doesn't even have to go up. It could be going down less than the market, and the relative strength line would be going up. So you're looking for stocks that are outperforming during corrections and then buying them as they come out of that correction coming from bases. And that's just classic O'Neill strategy and classic the way the market works. Um, yeah, and the blue dot. The blue dot is a
Let's
great.
talk about that one as
Yeah,
well.
I mean the blue dot is just, again, these are just go to, particularly in a correction. When you're in a correction or bear market, these are your go to screens where you're going to see, very seldom will you ever go back in a cycle and look back at the biggest winning stocks and not see that these screens pick them up early on. It just it's like a net that you just can't get. You call through the waters and it's just going to scoop up the fish. They're going to have to be in the net.
So let's go through and look at some examples that I've gone through. So I went through the Minervini trend template, the RS line blue dot, and tried to show you guys some examples of previous stocks. And Mark talked about NVIDIA early. So May 17th of 2023, the NVIDIA was in the trend template 1 month folder. A handful of weeks later, it was in the 1 to 4 month folder. So, you probably had heard of NVIDIA by then, but if not, it would have been showing up on your screens as potential idea when you were doing this work. So let's pretend you'd never heard of NVIDIA at the time, Mark, and all of a sudden it shows up on your screens. Now, how would you handle something like this? Say, let's pretend it's July 11th and it's shown up twice on a trend template list.
So right now it's showing up, it's in an uptrend, but it's not in a base. So I'm going to stay away from it. I'm going to wait for it to consolidate. And once it consolidates and then completes what I call a volatility contraction, I'm going to buy it coming out of that right side, that tightest point in the right side. And I'll tell you exactly where we bought it. We bought the stock. You can, I think it's even on the chart. I don't know if you have the chart, but you can point it in, you know where it is. On that up week right there. Or that's actually, that's a weekly or daily? That's
I'm sorry, this is a weekly, so that's
yeah,
coming
that's a
out of that
weekly.
flat base. That's where you showed me exactly that week as it
You see
emerged
how
from that flat
tight it
base.
gets on the right side there, and you see that relative strength line just takes off, and you could see the relative strength line actually probed into new high ground a couple, maybe 4 weeks prior. Yeah, right there. It's already coming up. That's going to come up on the blue dot screen. The relative strength making new highs. All that's going to happen there. And now it gets nice and tight, and you can see how efficient too that move coming out of that base. Here's something I also want to point out. I hear people all the time saying, base breakouts don't work anymore. It's an old, it's the most ridiculous thing that I ever heard. You go back to 1800. I'm sure they told Jesse Livermore the same thing, and I'm sure Nicholas Darvis heard the same thing, and Richard Love and Bill O'Neill, and you name it. And I've been hearing the same thing for 40 years. So, and they've been working for 40 years. I made my entire fortune on base breakouts, and I'm still making it. And won two U.S. Advancing Championships 24 years apart using base breakouts. So, but here's the thing: the argument is that base breakouts don't work. Everybody follows it. This is one of the most followed stocks that you possibly could find that would be like efficient as can be. One of the most heavily weighted stocks in the S&P 500 and the Nasdaq, and the base breakout is beautiful. It's perfect, and it worked in other times too within its life cycle. That is about as good as it can get from a base breakout. And if you look at all these names, you look at all the big names, they all had great opportunities to buy coming out of basis. So yeah, but here's what I want to point out. It's really important. Remember, the trend template is a qualifier. It's not a buy signal because it's on the list. It just simply says it meets the uptrend, and now you have to look for an entry point coming out of a base.
Perfect. Okay, so here's another example, and this kind of falls perfectly into what you just mentioned. July 14th, it shows up on the trend template. Doesn't mean you run out and buy Spotify at that time, but it might show up on your idea list, your watch list, and guess what? It builds like a 12-week cup with handle, and then breaks out from there, kind of like what Nvidia did. And the RS line is new high as well.
Yeah, and sometimes I don't buy it till much after that first or second base. It might have a base, break out of that base. It's in an uptrend, and then it's been in an uptrend for maybe a year, and I'm buying it out of a second or third stage base. Some of these are, earlier bases. Yeah, you had other opportunities to buy many of these names, and you will have the same with other names going forward.
All right, let's oops.
I
So,
really,
I jumped ahead. I apologize.
yeah, go ahead.
One last one.
Yeah,
Celestica, June 6, 2023. This was actually a little bit more timely. It actually broke out the next week, but
yep.
it was on the 1 to 4 month, broke out of this double bottom.
And again, you can see how this is, pretty early in that new upcycle. So it's not like this is waiting for it to have this information that is going to be 6 months or a year later. I mean, as soon as it starts to turn up in that uptrend, it's going to hit those lists. So that's why you want to monitor that on a regular basis.
So the action from, it's kind of off the charts here, but basically around 6 all the way up to roughly 12, that's the uptrend that's creating the template that's pushing this name in there, right, Mark? It's that prior uptrend.
Yeah, absolutely. And you want that inertia. You don't want, I have a saying, you don't want to be you don't want to buy the lowest price. You want to buy the right price. You could buy the lowest price and sit there for 5 years while the stock does nothing and lose a lot of time. In a stage two uptrend, you're gaining value and you're optimizing the use of time. In every other stage, in stage one, when stock's moving sideways, you might not even be losing value, but you're definitely losing time, and you might be just flatlining the value. In stage three, topping, maybe you're not losing value, but you're not gaining value, but you're losing time. In stage four, the downtrend, you're losing both. You're losing value and time, the worst possible scenario. So stage two is the only stage you want to be in, because there you're gaining value and you're using it, you're doing it as fast as you can, so you're compounding the money faster. That's why stage two is the only stage you ever want to be in. It's the only stage I buy any stocks. I haven't bought a stock out of stage two in 30 some odd years.
Wow, cool. All right, I love the way you put that with the different stages. Okay, so the RS line new high, we talked about it earlier. What the relative strength line is it's measuring the stock you're looking at versus the price action of the S&P 500. An RS line going up, think about like a clock. 12 o'clock on an RS line would be perfect. 3 o'clock would be neutral. 6 o'clock would be awful. So you want something around. I mean, 12 you're asking too much, pretty much. But you'd want a 1 or a 2 o'clock on a clock as far as your relative strength. And
I
here's some examples. I'm sorry, Mark, go ahead. You had something about?
I've seen them go to 12 o'clock.
Yeah, they can, huh?
During bear
Uh,
markets, you'll see 12
that's
o'clock.
true. That's
Yeah.
true.
Mhm.
CF Industries in the aughts broke out of this cup with handle, and the relative strength line was making new highs as it did that, and quite a move. It's nice and tight, really short, tiny bursts on the blue weekly bars, but that kind of makes it easier to hold. And then it ran into trouble as the market ran into trouble in late 07, early 08.
Now,
Uh,
something to point out, IPOs are you're not going to have the data to be able to meet a stage two uptrend sometime. If there's only, let's say there's 8 weeks or there's 13 weeks of data in a new IPO, well, then the stage two, you're not gonna require that it's in a stage two uptrend. Now you're just looking at the current chart pattern, and you'd want it to be above the 50 and the 20, and you'd use the faster moving averages. So that's just a caveat that you have to realize that you're not. It doesn't mean that a stock is off the table. It's an IPO because it doesn't meet the stage two uptrend. It can't when it doesn't have enough data.
doesn't have the price history. All
Yeah.
right, so here's App Lovin breaking out of this really large base, and the RS line, that's almost at 12 o'clock, just like you said.
Yep. Yeah, there it is. I mean, it's, very just almost straight up prior to the breakout. You see, it's already going into new high ground, and that's what you want to see. That's why you would use that screen to look for the stocks that are outperforming when they're in a base. And usually the market's correcting. That's your best scenario. Like right now, you should be looking for stocks that have relative strength lines that are improving, moving up, breaking into new high ground, and stocks are in bases. And they may not even have broken out yet. But usually when you get that scenario, the breakout is not too far away. So you gotta be ready to act.
Last but not least in this category, Palantir, RS line a handful of times, but I just wanted to highlight a couple of them where the stock had a really kind of a nasty shakeout on the daily, but look at that weekly bar, and you have the
Yeah.
RS line at new high as the stock is emerging into 52-week highs.
And these are all in stage two uptrends, would all meet the criteria. You would not miss them on either of those screens. You're going to see a lot of overlap and see these on
Correct.
various screens, and that's a good thing. If you're seeing on the stage two uptrend, you're seeing it at the relative strength new high screen, and then if it meets the earnings criteria, which some of these names we're talking about, are very powerful earnings. Palantir, a super smart CEO. He's kind of a quirky guy. He's fun looking, and I love him. I love him. I love what he's doing. The stock's extended right now, but this could be a next big winner that has a secular move, even more than it's already made.
And a good point, Mark. Yeah, this wasn't only on the RS line new high. It was in the Minervini template, was in earnings gap up list. So they will show up on, usually the best ones do, right?
Yes.
They pollinate across a number of different types of reports and screens. All right, so the blue dot it's a little bit like the RS line, but there's a caveat to how that blue dot shows up. So the RS line has to be at 52-week highs, and secondarily, and has to occur as well, the stock has to either be in a base or emerging from the base if you're on a daily chart on that day, or if you're on a weekly chart on that week. And that will highlight with that blue dot circle at the very end of the RS line. So here's Palo Alto Networks, a historical example, breaking out of this flat base and the RS line blue dot as it does that. And you can see how you had a little bit of a head fake below the 10-week line about 5 or 6 weeks into the move, but otherwise was a pretty easy hold as it held that moving average the whole way up.
Yeah.
And then currently at Agnico Eagle Mines, the gold sector has been really strong. So this was on the RS line blue dot list as it emerged from that cup right there. And I thought I'd give you one today. Landbridge, I think Antero Resources as well in this same group, but this is what it would look like on your chart. So Landbridge is breaking out of this double bottom today. It broke out today. And the RS line is at 52-week highs. And so the blue dot would be on the daily chart as well as the weekly chart. And then it gets dumped into that list, and that it'll stay in that list for 45 days. So you'll have kind of a historical track record, a trailing 45 days of the blue dot.
Yeah, that RS line is leading too. It's going to new high ground before the price.
Yeah, I think it was in the new high ground yesterday. So while the stock was slightly red, the RS line was already, basically there. Okay, so again, the offer is $24.95 for today only, March 19th. If you watch the recorded version, I apologize. You'll get a lot out of it, but the offer will not be valid. The $24.95 for 1 month will be fine. But if you're on the fence, take advantage of the free 2 weeks. So you'll get 6 weeks for $24.95 if you sign up today. 800-831-2525. You can call us and we can take care of it for you, or investors.com/webinar offer. We actually made pretty good time. So I think if you've got time, Mark, I'd like to, if my colleagues could maybe shoot me a couple of questions that everyone has for Mark. I know there's a ton of questions, but
let's do it.
Fire some questions to me, guys, that you think all right, so let's start with one that Jerry wants to says people want to know where the trend templates are. So
easiest way is up there in stock ideas.
Yeah,
then it takes
I
you right
added
to
it to my favorites. So what I did here is I'm in the favorites tab. I hit add, and then I go to reports, stocks, and the subfolder technical. If you scroll down, what did I do wrong here? Oh, I didn't open the technical. I apologize. You have to open the technical. You can see I've checked the box for all RS line, blue dot, and the Minervini trend template. If I wanted the 5 month, I could check that box. 5 month wide ants list. I could check it all, the ones I prefer, and it just makes it nice and easy in the favorites.
And you can shortcut right to it too if you just go to is it under correction or uptrend?
It might be under weekly review, uptrend. I'm on daily review. There's the 5 month right there. So it's in the uptrend tab under weekly review. There's
what I like about this is it brings you on the bottom panel on the left, it brings you right to all of them.
Oops, I'm sorry. They're stored down here. Let me pull this up so you can see. So let me
click
close
on
this.
That'll take you right to that.
So all of the pretty much everything you'll find on this left-hand panel under this subfolder called reports. So the open stock ideas is kind of like a table of contents of everything that's down here below. Arnie says, let's show how to change the database to the Minervini screener again. Okay. So if I create a new screen, I'm going to call this Arnie, since he provided the question.
And you can do this with anything. You can not just my screener. You can choose the database to qualify it with other different.
Yep. So here's the
screens.
reports. Here's the technical. So you could do that with a Minervini trend template, or I could do it with, imagine I wanted to screen the RS line new high one. Let's go to that one.
You could start with that as a qualifier.
All RS line new high, select. And now I'm looking for inside the universe of 780 stocks instead of 10,000. And just to make it easy, I could say I want an EPS rating of at least 70. And
Scott, another thing to point out is that it's actually my screens are a good gauge of market health too, because when you're in a really healthy market, you're going to see a lot of stocks and uptrends. And when you start seeing that thing come down where the 5 month has got 100 names, it's not a very good market. I mean, I've seen like 1,000 names in the 5 months, and then I've seen where there's 90 names. And so I'm not sure where it is now, the 5 month, but certainly you're probably dwindling down from some of the peak numbers that you had when the market was really strong. It almost acts as a market gauge as well.
It's funny you say that, because in-house we do have noticed, like if there's a lot of stocks on the near pivot list or a lot of stocks on the breaking out today list, it could kind of give you a feel for the quality of the market at that moment.
Yeah.
You cannot screen multiple reports into one, so I can't choose the Minervini and the all RS line new high. It's just a single report or the database. A lot of you said you called and were unable to get through. Let me show my screen again. Investors.com/webinar offer if you need to do that online. Some questions on Weinstein. Let's maybe a
No, I'm
little
not
bit
going to
of
tell you where
this.
we're having dinner.
The stage 2 trend that's from would you recommend people read his book? Where is Stan's book?
Absolutely. Stan's book is a must read. It's a classic, you know.
It was one of the first books I ever read. I'm trying to find it in my bookshelf.
Profiting in Bull and Bear Markets by Stan Weinstein.
There
Yeah,
we
it's
go.
awesome. I mean, Stan is my very good friend. I love him dearly, and I didn't know him from a hole in the wall in 1990, and he was so generous and so helpful, and was willing to have lunch with me, and just he's an awesome guy. Anybody
No,
who
it's
knows him knows what I'm talking about.
profiting in bull and bear markets, and he's on the cover. So Weinstein is Weinstein. If you search on Amazon or whatever, you'll find it for sure.
Yeah, great primer for just the fundamentals of technical analysis of the very first thing that you should learn.
Okay. All right, Mark. Well, I really appreciate it. We did this in an hour on the button, and that's great. I'm glad. And again, you guys could take advantage of the offer, but this will be archived. So if you just kind of want to review it, and if we went too fast in certain areas, I apologize. But go to investors.com/webinars, and under the video tab, you'll be able to find this probably in the next handful of hours.
And I don't want everybody to think that I'm going becoming a massive bear. I know I showed some ominous readings there, but these things can go on for a long period of time, and the market could stay very exuberant, if you will, or frothy, and secular bull markets could go on. But just be respectful. This is all why you use stop losses, and when the stocks aren't working, you let them stop you out, and you go to cash, and you wait for stocks to be in uptrends and to be coming out of bases, and just stay disciplined, and you won't get caught in those downturns, even if we have major corrections.
Yeah, a couple of people asked questions about, the stop loss policy that you have. So if you put on a position tomorrow, do you use like some kind of the way the stock trades to evaluate the stop, or do you just do
Yeah.
a hard 5% regardless, whether it's BABA or XYZ?
So I'm always trying to back into the stop, so the volatility of the name would agree with the type of percentage stop that I would want to place. So for instance, that's why I want that right side, that real tight entry point, to be in single digits, because I don't want to take a bigger than single digit loss. So I'm using the low of that pivot or the low of the base as a stop technically. But if I can't find that and it's a name I really want to own and maybe it's a little more volatile, well, then I'm just picking an amount of money that I am willing to risk. And that's really it's really that simple. I'm going to go. But again, if you don't let stocks fluctuate, you're going to get stopped out, and you're going to get whipped around quite a bit. So you got to have some fluctuation, and that's why it's important to go with the stocks that the volatility is calming down and get that expansion out of those volatility contractions. Because if you go into the volatile names, they're going to be whipping all over the place, and they're not really doing anything wrong. They're just kind of doing what they do. Meanwhile, you're getting knocked all over the place because you don't have the risk tolerance.
Okay, so
If that makes
again,
sense.
thank you, Mark. So, and I apologize because there is some confusion with people on the offer. The
Yeah.
offer will say 1 month for $24.95. On the back end, if your order went through on March 19th, we will credit you the 2 weeks. So I apologize for the confusion if it was any. We will credit you the 2 weeks. I promise you that. It won't happen right away. You'll sign up for 1 month at $24.95, but you will get 6 weeks of service. So
Hey,
hopefully that clears it
I've
up.
been paying these guys for 30 years. Take a shot with 25 bucks.
As we're,
I don't
I
think
mean,
you'll
we're
find a
practically
better.
giving it away, right?
Yeah, I mean, look, MarketSurge is the category killer. I don't get paid to say this. It's the category killer. That's why I've been using it for 30 years. There really is no competition. So for what it does, it's the best out there. And the O'Neill products, the institutional products, which are 20 times the amount, you're getting 98% of what the big mutual funds are using. This is really the greatest deal out there. I couldn't be happier than, what the daily graphs and all the MarketSurge and MarketSmith and products have done for me. Without them, I'm not sure. I've said this before. I'm not sure if I could have done what I've done in the market if I didn't have them, because I didn't have the software that I have now. This was really the only game in town for a long, long time.
Yeah, for sure. It's great. Thank you, Mark. So I really appreciate you joining us. Thank you as always. It's always educational, and people really appreciate you taking the time out um, to help. I learned something. I actually, the thing that I wrote down and circled and starred was the stage two. The comment you made about stage two. I thought that was very powerful. So we really appreciate it. And everyone, thank you for taking time to join us on a Wednesday. And once again, this will be posted on the website. You can watch at your convenience.
And I appreciate it. I hope everything was helpful for everyone, and we'll do it
For
again.
sure.
Okay?
All right, great.
All right.
Thank you, Mark. Thank you, everyone. Have a great day.
Take care.